Picture this, a bank car loan at 4%. You get approved. But with a lower credit score, that rate jumps to 22%, or no approval at all. Nothing about you changed, except one 3-digit number. And most people never think about that number, until the day they actually need it. By then, it's usually too late. Here's the thing. Most people treat their credit score like a school grade. But it's not a grade, it's a price tag. Every point on that scale is quietly attached to a real dollar amount. You paid an extra $47,000 interest because your score sat in the 640s instead of the 760s.
This isn't about being a responsible person. It's math. Cold, compounding math.
Why people misunderstand it? Because your score is invisible until it isn't. There's no monthly report card. You find out it matters the day you're standing in a dealership or signing an apartment.
Checking your own score does not hurt it. Carrying a balance does not help. Closing an old card shortens your history and raises utilization.
So let's walk through the full scale. Rock bottom to perfect. The full spectrum, 300 to 850, 300 to 579, the deep end. This is usually life after bankruptcy, or accounts sent to collections. At this level, a traditional card isn't happening.
I'm sorry, we can't approve your application at this time.
You're stuck with secured cards, putting down your own deposit, just to prove you're trustworthy. Renting means finding a landlord willing to take a bigger deposit, or bringing in a cosigner. A car loan usually means a buy here, pay here lot, with rates that can run north of 20%. 580 to 669, fair, but it doesn't feel fair. This is a strange zone, because you're technically approvable for a lot. You're just approved at the worst possible price. A mortgage, yes, but with a higher rate and probably private mortgage insurance stacked on top.
A credit card, yes. But the good rewards cards aren't on the table yet.
This is where the most frustration lives. Because life here feels fine, bills paid, no disasters, while quietly overpaying on everything. 670 to 739. Good. And this is where most people actually sit. Mainstream approval across the board. Decent mortgage rates. Solid rewards cards. But still leaving real money on the table compared to the tier just above. 740 to 799. Very good. And this is where the door really opens. Now lenders start competing instead of judging. The best advertised rates you see in commercials become realistic. Premium travel cards with genuine welcome bonuses. Auto loans that are genuinely cheap. A lot of people are closer to this tier than they think, sometimes 1 or 2 habits away. 800 to 850, exceptional. Here's a fact that surprises people. Past roughly 800, loan pricing barely improves versus someone at 760. Lenders basically stop caring past a certain point. In New York, you're already filed under safest possible borrower. What changes up here isn't the rate. It's the ease. Instant approvals. Higher limits handed over unprompted. Offers arriving before you even ask. A real-world example. Let's make this concrete with something almost everyone does eventually. Financing a car. Say you finance a $35,000 car over 5 years. In one version of your life, your score sits in the high 700s. You're very likely getting a rate in the low single digits. In another version, your score sits in the low 600s, and you're paying hundreds more every month. Over 5 years, that difference can easily become thousands of dollars.
And here's the crazy part. Both people bought the exact same car. The only difference was the credit score.
So what actually moves your score? Not income, not your job title, not how much money you have in the bank. It's mostly about whether you pay on time, how much of your available credit you use, and how long you've managed credit. In other words, your credit score is less like a report card and more like a reputation that updates every month. The good news? Most people don't need a miracle to improve their score. They just need consistency. Pay every bill on time. Even one missed payment can hurt more than people realize.
Keep your credit card balances low instead of maxing them out.
Avoid opening too many new accounts in a short period of time. And above all, give it time. Credit is built through consistent habits, not overnight fixes. A higher credit score doesn't mean you're richer. It means lenders see you as less risky. That's the entire game. You're not trying to impress people. You're trying to reduce risk. Because once lenders trust you, money simply becomes cheaper. And that's why those three little numbers quietly affect almost every major financial decision you'll ever make. Run that gap over 5 years, and it's not a rounding error. It's often several $1,000s in extra interest for the exact same car. This is one complete idea. Same purchase, different total cost. Same dealership, same model, same color even. The car doesn't know your credit score. The finance office absolutely does. What's your credit score today? 300, 650, or 800 plus? Let us know in the comments. And subscribe for more money lessons that actually save you money.